I changed how I invest my money because of AI. For almost a decade, I had one strategy, and it was the boring
an S&P 500 low-cost index fund.
Instead of betting everything in one company, you own a tiny slice of the top 500 companies in the US. And here's the thing, as I grow older, I've got more responsibilities and more risk averse. And AI made me sit down and rethink everything. So today, I'm walking you through the 4 things I changed how I invest because of AI. Stay until the end because number 4 is where most people hurt themselves the most. First, I'm changing how I see the S&P 500. The S&P 500 is going to become the S&P 8 soon. Today, for every dollar you put into the S&P 500, almost 40% goes into just 8 companies. We are talking about Nvidia, Apple, Microsoft, Amazon, Google, Broadcom, Meta, and Tesla. Together, they make up to 38% of the entire fund. How did that happen? The S&P 500 is what's called the market cap weighted. Basically, the bigger a company gets, the more of the fund it eats up. It is like a buffet where the fattest guy keeps getting served first. So what is making all these companies so massive? The stock market isn't pricing AI on what it can bring today. It is pricing it on a future that doesn't even exist yet. Right now, for this valuation to actually make sense, AI will eventually need to capture 10% of all corporate profits on earth. High valuation is not always a problem. High growth company tends to get high valuation. But when it is all the same bet, all on AI, and all funded by massive debt, that is a different story. Think of it like an influencer cafe. The owner borrows money to pay 10 influencers to sit at the cafe all day, making the place look so packed it hits every top 10 list. The crowd outside, the passive investors, sees the queue, feels the FOMO and rushes in. Their presence keeps the cafe number 1 on the list, which attracts even more people. But here is the catch. The owner is still paying those influencers under the table, and that is the hidden debt. AI companies are passing money between each other in ways that makes everything look stronger than it might actually be. Bigger companies attract more passive investors, which pushes their price up, which gives them an even bigger share of the index. Without the massive wave of AI investment, the US might already be in a recession. Does that mean you should panic? No. But it does mean you should think about it carefully whether you are more concentrated than you realize. Quick question, do you think the biggest stock market returns over the next 20 years will come from the US? Most people would say yes, and I honestly get it. For the last 14 years, America has absolutely dominated. But let me show you something. Go back to the 1900s. The UK was the global superpower. They held 24% of the entire world stock market. London was the financial capital of the world. British companies ran global trade. The empire was everywhere. If you were investing back then, you would have felt that completely obvious that the UK would stay on top forever. People would have laughed at you for putting your money somewhere else. But you already know how that story ended. Or think about Japan in the 1990s. When I was young, I saw how Japanese companies were crushing it. Cars, electronics, and technology. Meanwhile, the US economy was struggling. Inflation was high, growth was slow. A lot of people will say you are crazy for putting money in the US, but America came roaring back. Here is the lesson. The only thing that's certain in the market is uncertainty. That's why I don't want my entire portfolio depending on one country and AI. Because when you only hold the S&P 500, you completely miss companies like TSMC, Samsung, Toyota, Tencent, and HSBC. These are massive global businesses driving real growth. They are just excluded because their headquarters are not in the US. So the second thing I have changed how I invest my money because of US and AI dominance is I have switched to a World Index Fund. A World Index Fund normally has 65% in the US, 25% in Europe and Pacific, and 10% in emerging markets. Now, I want to be clear. While a World Index Fund reduces my concentration on the US and AI, it is still subjected to overall market risk. Now, for Singaporeans, here is how I actually invest in the World Index Fund. Just a quick note, I'm not licensed to give out financial advice. These are not recommendations for you. These are options that are popular among Singaporeans. Please do your own research before you invest. If you want the maximum tax benefits, investors here go for Ireland domiciled global ETFs listed on the London Stock Exchange. But that means using interactive brokers. And honestly, signing up interactive brokers can feel like applying for a government job. Some beginners prefer US listed ETFs for simplicity. Longbridge is one platform where these ETFs are available. It only took me 10 minutes to open an account with Longbridge. Even though this segment is sponsored by Longbridge, hear me out. I will only work with a broker I'm comfortable using my own money. I could make more money promoting every sponsor that comes to me, but there's no honor in that. I would rather run my YouTube channel at a loss and be able to look you in the eye if we bump into one another. Yes, buying US listed ETF means you will be paying more dividend withholding tax compared to London listed ETFs, but it is still way better than not investing at all. You can actually make up part of that difference through the rewards Longbridge offers, and most US listed ETF has a lower expense ratio than the London ones anyway. Longbridge gives you lifetime $0 commission on US, Hong Kong and Singapore stocks. Now you're thinking nothing is free. You're right. For US stocks, there is still a platform fee of $0.005 per share with 99 cents minimum. But if you deposit $2,000, new users can get $0 platform fees coupons, which actually matters because your first trades are usually your biggest. There are other fees, but these are not Longbridge fees. You have to pay them regardless of what brokers you use. All in, the total cost is extremely competitive to other brokers. And here is the deal. If you deposit $2,000, hold it for 30 days and make 3 trades, you get $80 in Nvidia shares. That is like a 4% return for showing up. If you want these generous rewards, sign up by scanning my QR code or use the link in the description. I may earn a small commission if you sign up at no extra cost to you. Thank you so much for trusting my small YouTube channel. Here is something a lot of Singapore investors don't think about. When you invest in the S&P 500 or global index, you are still betting heavily on the US dollar staying strong. With everything that's going on in the world right now, that is a bet I personally want to reduce. So the third thing I have changed is adding some Singapore stocks to my portfolio. It is kind of like you wouldn't want all your eggs in one basket, and you also wouldn't want all your basket made of the same material. Since Singapore stocks are priced in SGD, they protect you from the US dollar. Think of DBS, OCBC, UOB. Our 3 local banks. They are not flashy AI companies. They are just solid, profitable businesses that benefit from the growth right here in Asia. I'm not saying you should put all your money into the Singapore market. It is smaller and you won't see the same kind of fast growth you get in the US. But having some local stocks helps to balance things out. It means that your life savings are not just riding on the US dollar or whatever is happening with the AI stocks. By the way, all of these are accessible directly on Longbridge. This might be the most important change in this whole video, and it is the one people are most likely to skip. It is not about not investing. It is not having enough cash set aside. In my previous video on the smartest order to invest your money in Singapore, you saw how my friend sold his investment at a loss to pay for a non-negotiable live event. I have put the link in the description. Even Warren Buffett, the most successful investor of all time, is holding more cash right now. As of early 2026, he's sitting at 370 billion in cash. He's a value investor. He only buys when the price makes sense. And right now, he doesn't see enough opportunities to justify putting that cash to work. If the greatest investors alive is keeping more cash in his pocket, maybe the rest of us should think about that too. So the fourth thing I have changed is to increase my cash position for my emergency fund and my short-term saving. Here is how I'm keeping my cash. The first $10,000 goes into a regular savings account. I can get to it in 5 minutes if I need to. Anything above $10,000, I combine it with my short-term savings money and park it in the money market fund. Right now, a money market fund that's caught my eye is the iFast SGD Enhanced Liquidity Fund. The idea is simple. Keep your money safe, grow it a little, and make sure you can access it when you need to by spreading it across high-quality bonds and bank deposit. Just a quick note, this is low risk, not no risk. Your capital is not guaranteed. Most savings accounts are pretty disappointing. They pay a tiny 0.05% interest. And to get that bonus interest rate, there are so many gimmicks like making your salary goes into that specific account or hitting a minimum spend on your credit card. The iFast SGD fund is as simple as it can be. You can invest in this fund using Longbridge. Just enable the Cash Plus features in the Longbridge app. After that, any cash sitting idle in your account gets automatically invested into the iFast fund. You don't have to do anything else. At the time of recording, the iFast SGD fund has returned 1.7% per annum on a 7 days annualized basis. If you sign up using my QR code or link in the description, you will get a 10% per annum interest boost coupon on your first $2,000 for 180 days. That is an extra 4.9% in half a year alone. Combined with the fund 1.7% return, you are hitting 6.6% in your first year. You will only get this boost if you sign up using my link. I may earn a small commission at no extra cost to you. Now, here is something I haven't touched on this channel. It is dividend investing. But here is the controversial part. Some people think that dividend investing does not make any sense. If you want me to make this video, show me your votes by subscribing to my channel now, because I have a feeling the comments are going to be very entertaining.